Okay, this video builds off of the last one talking about net operating losses. So when you have a net operating loss carry forward, meaning you lost some money this year and you have now a deferred tax asset because you're carrying the loss forward, meaning the next X dollars of income you earn, you won't have to pay taxes on that. So when that happens, it's going to look like this situation from the last video. You're going to have a benefit due to your loss carry forward. You're going to have your deferred tax asset. And this comes from the last video. It's $80,000. And this is your income statement here because you also used a carryback. Anyhow. Here's a question for you though. What if it's more likely than not that Tommy, being the company, Tommy Company, will not realize the entire net operating loss carry forward in future years? This is an accounting issue that came up because there were some companies, I can think of one, Yahoo. Yahoo had multiple operating losses, and so they kept losing money, and you can carry it forward up to 20 years. So they generated very large deferred tax assets, but the FASB paused for a minute and said, wait now. Who's to say you're ever going to make money again, Yahoo? I mean, Google's crushing you, so isn't it a bit misleading to put this big asset on your balance sheet? People that don't understand financial accounting very well might just look at that and add it up and say, oh, total assets are X dollars. It's a bit misleading, right? So enter the valuation allowance. This is a way to reduce the deferred tax asset when you believe it's more likely than not that Tommy will not realize the entire net operating loss carry forward benefit in future years. That's what we're going to do. We're just trying to reduce it to its expected future value. Okay, so if we think we're not going to be realizing it, we have to debit the benefit due to loss carry forward, and we credit this account with a super long name, allowance to reduce the deferred tax asset to its expected realizable value. So it goes on the asset side of your balance sheet as a credit. It's a contra asset, and it just hangs out with a deferred tax asset. Okay? And your new income statement would just look like that. That is an extreme example. A lot of times you would reduce the deferred tax asset, but not by 100%. Okay? You would reduce it by half or a quarter or whatever. Okay? In that case, the journal entry, the accounts are exactly the same, but the amount would be lower. All right? Okay, that's the end of this video.